SOFI is a very popular stock among retail investors. The stock used to be trading at $28 per share in March of 2021, I believe, and it's now sitting at $6.94 per share. It used to be sitting around $4.50, but then it made a huge move whenever we had the student loan repayment, as SOFI does benefit from student loan repayments. But there's a lot of risk with the stock, a lot of controversy among investors. Some people believe that just consumers are too weak, they're going to default on those kind of personal loans and all these kind of loans that SOFI has been giving to consumers. And there's another view where SOFI is some kind of a growth company, a growth bank, and it has a pretty bright future ahead. This is what I'm going to try to discuss in this video. I'm going to analyze SOFI, try to value it, give you my fair value, and just talk about the risks in general and see how exposed SOFI is to the risks that most people are talking about. Now, if we look at the insiders trading, no one has been buying pretty much but the CEO. The CEO has been pretty much the only one that's been buying, and the other insiders have been selling the stock like never before, a lot of officers and stuff, but the CEO and sometimes the CFO have been buying a lot of shares. The latest transaction was around 44,000 shares at $6.77 per share, pretty much like 6 or 7 days ago, which wasn't too long ago, and it's a pretty good signal in general if you ignore the other ones that have been selling. And SOFI had a lot of success in advertising their product, especially that they are paying pretty much 10 times the national average in terms of interest rate. A lot of banks like Chase are still paying like 0.01% or something crazy. SOFI has been paying 4.6%. I believe sometimes they had something like 5%. So they were advertising it on TV, and a lot of people signed up for SOFI accounts. And once you sign up for a SOFI account, they try to cross-sell you a lot of the products, maybe the car loan kind of product, maybe a home loan, maybe some kind of student loan services or some investment account, buying stocks and ETFs. And a lot of people are using SOFI for everything. They don't need to have a Chase account, have a Robinhood account, have this account, and that. They're using SOFI for everything. And a lot of people have been finding it very, very convenient. So it was pretty smart, in my opinion, for SOFI to advertise something that most people use, which is a checking or saving account, paying a very high interest rate. It got a lot of people to sign up, and then they cross-sell them a lot of the products. And we can clearly see it in terms of members additions. I mean, it has been stellar, over 47% year on year, even though SOFI has pretty close to 7 million members. And it's been growing rapidly. I mean, I've been very impressed by the fast growth that SOFI had. Now, this did not come at any cost. They did spend a lot of marketing, advertising on TV, on NFL's kind of pre-games and many other places. So it hasn't been cheap to get all these members, but they've been staying so far, and they cross-sell them a lot of products, which is very, very interesting. Now, this is where most investors are worried about, and it's mainly the credit card kind of borrowers, delinquencies, that now people are paying back their student loans. Maybe it's bullish for SOFI because SOFI services the student loan payments, but also it could be somewhat bearish for SOFI because they don't have much of a disposable income or extra income to service all the home loans and all the kind of personal loans that they got from SOFI. So they might be delinquent on a lot of credit card bills, a lot of on student loan bills, and many other things. So a lot of investors are worried about this risk. And if we look at the credit card kind of delinquent, the percentage, it's now around 2%, which is pretty much higher than it's been pretty much since 2015 on this data. It's the highest it's been, around 2%. This is not good at all. And in my opinion, it will most likely get worse with the kind of inflation, sticky inflation that we have, and much higher interest rates is killing a lot of customers. I mean, interest expense is high to most people. So I mean, I would not be surprised if this goes up a little bit more. But this is the kind of risk that a lot of investors are worried about. Now, this is something I discussed in my previous SOFI analysis pretty much in early 2023 when I did my video. And this is the FICO score exposure for the SOFI kind of credit card products. And if you look at the credit score exposure for SOFI, they do have a lot of people with 800 plus credit scores, which is pretty amazing in the United States, between 780 to 800. So they have pretty good stuff. But if you look in terms of the lowest credit scores, the ones below 599, they experienced massive growth. They had no customers. Now they have around 31. from 600 to 619. This is also a pretty bad category. They also got an increase in kind of loans over there. And same thing between 620 to 639. They also had an increase from pretty much nothing. Now, this told me that SOFI is getting a little bit desperate to try to grow members, so they are trying to advertise to members that don't really have a good credit score just to increase member count and increase the income for the time being. So they are sacrificing quality for growth. This was my kind of bearish take on SOFI early on, and it still stands true because I personally don't have the recent FICO score data for SOFI. They did not publish it on the quarterly report. This is from the annual report of 2022. So maybe now things have improved, and I'm being honest with you, they kind of have improved a little bit because this is the latest data that I have from their own quarterly report, and this is just for the direct deposit accounts, for the saving account and checking accounts that I told you they've been advertising. So for that, the new direct deposit account, they have an average credit score or median credit score of around 743. So this is a pretty good sign that SOFI is shifting from the lower end kind of customers where they were trying to grow as fast as possible to more of some kind of a pretty good customer around 740, 750, 760. So this is a pretty good improvement. This is just on the deposits, checking and savings. I am not sure about the personal loans. I am not sure about the credit card stuff. I could not find it on the quarterly report, but I did find it on the annual report. And from 2022, they had a lot of new people signing up with below 599 credit score. This is like the worst of the worst. And they were apparently giving them credit cards and loan, maybe for higher interest rate, to try to grow as fast as possible by sacrificing quality. But again, SOFI has been proving me wrong in this quarter with the checking and saving with a 743 credit score. So this is really a pretty good improvement in my opinion. And one metric we can look at to determine the kind of risk that SOFI is facing with that stuff is the annual default rate on personal loans. It used to be around 4.4% in December of 2022. Now in September of 2023, it's around 4.6%. And it's not a huge increase, but it did increase a little bit. So that would tell me that so far, SOFI is not experiencing the kind of bearish case that most investors have, that all these customers are broke and the whole thing is going to blow up. Maybe it will in the future. You never know. We don't know yet. But I did show you the credit scores and what kind of exposure SOFI has on a lot of the credit card stuff. So this is something we have to monitor over the next few quarters to kind of determine if the bearish case for SOFI that consumers are broke is actually playing out, or maybe the consumer is more resilient than most people and investors are expecting, and maybe they're not going to have a huge default rate where just SOFI is just drowning in debt and defaults and stuff. This has not happened so far. The trend is going there, but it's very slow, and we have to look at it quarter over quarter to try to determine if this is eventually going to happen or not. Now, SOFI did make a lot of acquisitions. They did issue some stock over the last few years. In my opinion, they did create some value, but the value has not been realized because it's mostly within growth stuff like the banking license and all these kind of other mortgage and stuff they acquired. It's not currently showing up, but something I like to look at with bank is the tangible book value per share to see what kind of value they created on a per share basis. And in terms of SOFI, they pretty much have not created any value since pretty much June of 2021 on a per share basis. In fact, the tangible book value per share has been going down pretty much from 2021 to 2023. I look at tangible book. This is what the best metric, in my opinion, to look at with banks, even though SOFI is somewhat of a growth bank, so it might not be the most accurate one. But on a tangible book value per share, SOFI has not created any value, but they did grow a lot in revenues. They grew a lot in subscribers and members and all these kind of things. So maybe this will show up in the future in terms of profitability. They did have some stock-based compensation, which I'm not a big fan of, but it's been stabilizing. It's not been increasing every single quarter. In fact, it has been somewhat coming down from the elevated levels in 2021 and 2022, and I hope it comes down a little bit more. This is a good sign. I mean, it's heading in the right direction. I don't want it to keep going up every single quarter. So this is a pretty good improvement in my opinion. As most of you know, SOFI is still unprofitable. They did increase a lot in terms of revenues from 423 to 537. They did spend a lot on marketing. This is where all the growth comes from. $186 million on marketing, all kind of ads on the NFL and all these kind of things to grow members, which what SoFi should be focused on. In my opinion, SoFi should not be focused on being as profitable as possible. They should focus on building a reputation and building a name for themselves. And once they have more people within SoFi ecosystems, then they can monetize them and cross-sell them a lot of products and try to keep those members for life in terms of lifetime value. This is the best way SoFi should be going. And I believe the CEO is not stupid. This is what he's focused on. He's focused a little bit more on growth, sacrificing short-term profitability for long-term growth. And SoFi is eventually should be becoming profitable, but they did spend a lot on marketing. And in terms of the net loss in general, it did increase massively. They had some kind of goodwill impairments and stuff. Without the goodwill stuff, it would have lost a little bit less money. But it's a pretty good improvement in general. And this is what the analysts are expecting. They are expecting 2024 for SoFi to finally be GAAP profitable. Non-GAAP, it's been somewhat profitable on a per share basis. But in 2024, it's expected to be GAAP profitable around 5 cents per share. This is good news and has been improving. It pretty much troughed in 2021, losing $1 per share in GAAP earnings. And then it's 40 cents, 30 cents. It's going to be 5 cents in 2024. And I'm not sure about 2025, but it's expected to be over 22 cents per share. This would be a massive improvement for SoFi. And this is heading in the right direction. This is what you have to focus on in terms of unprofitable companies. Sometimes they are unprofitable, but if they're focusing on the right growth metrics and if the business is growing and if EPS per share is heading into the right direction, it's kind of improving, not losing more and more every quarter. I mean, this is the right track. This is something good with SoFi. And I have to admit, SoFi is a very hard stock to value, but I did my best to kind of fit in some numbers in my valuation model. I'm going to tell you exactly what I did and why I did them. And I put in $2 billion in revenues for 2023, which is with the first quarter should be around $2 billion. And then I put in 24% in 2024 in terms of revenue growth, and then 15% from 2025 to 2028. This is pretty much in line with the analyst estimates. It's around 24% for 2024. Then 18% in 2025 and around 12% in 2026. I believe no one knows what's going to happen till 2026. Maybe SoFi does more acquisitions and this is going to grow the revenues. So no one really knows what's going to happen. But I believe it's pretty fair to put in 15% between 2025 and 2028. I think it's pretty fair. Net income margin, this is the hardest one in the whole valuation model thing. I put in at 10%. It's extremely uncertain because if you look at SoFi, it's been losing money, as most of you know. In 2024, it's expected to be around 2%. Analysts are pricing in a 13% net income margin by 2026. Now, to me, this is extremely, extremely high. And it's extremely, extremely uncertain. No one knows, I mean, if it's going to be 13 to 15%. This is a very big bet. And I'm not even comfortable using something like 10%. But I used it here in the video for an illustration. On a PE ratio, I put in 25 times earnings for 15% revenue growth, 10 to 15%. I think 20 to 25 times earnings is fair for such metrics, especially if it gets to a 10% net margins, which I believe they could. So 25 times earnings, this would give me 65% on the upside or 10.5% CAGR. Now, if I want to double my money with something like SoFi, I would have to buy the stock at $5.67 per share. This is much, much lower than the $6.94 per share. And as I said, this is very uncertain. This valuation model is very uncertain. If you're a very long-term investor with a 10 or 15-year horizon and you have something like SoFi as a speculative investment, 1 to 2% of the portfolio, this is how I would do it if I had SoFi. I would never go all in into an unprofitable company with such uncertainties and such regulation risk and all these kind of things. But then SoFi is really not bad at such prices by using a pretty conservative valuation model, which is very uncertain because I don't know what kind of net margins SoFi could get. The CEO could surprise us. We don't know if they're going to do more acquisitions, grow faster than 24 or 15%. By using this one, I have something pretty close to $5.70 per share. I think SoFi would be a pretty good bargain at such price. But it was not financial advice. It was just my own opinion on SoFi stock. Thank you for watching the video. I really hope you enjoyed it. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.